5.2% unemployment in major cities, 84% of GDP in public debt, and a slew of important economic data has disappeared. The world's second-largest economy is facing unprecedented warning signs, with key indicators showing a sharp decline. China's economy on the brink. China's economy is undergoing a severe recession, experiencing a level of decline not seen in the past decade. While it remains the world's second-largest economy, the signs of weakening are increasingly evident. Unemployment in major cities reached 5.2% in March 2025, up from 5.4% in February 2025. This rise in unemployment reflects the downturn in the manufacturing and services sectors. Particularly hard hit are the youth, with many unable to find stable employment. Factory closures have become a common phenomenon, especially in the southern regions where many factories depend on exports. This reduces production capacity and affects economic growth. However, what worries analysts is not the disappointing data, but the absence of data. The Chinese government has stopped publishing several key indicators, making it impossible for the world and investors to accurately assess the real situation. Hiding this information only increases suspicion about the true health of the economy. Economic data disappears. Since the beginning of 2025, China has stopped publishing several key indicators such as urban land sales, youth unemployment, foreign investment business confidence, soy sauce production. Why hide these numbers? The answer likely lies in public debt, which is approaching 84% of GDP by 2025. The large increase in public debt will directly affect the country's financial stability and erode confidence in the economy. Moreover, China's real estate market is crashing, affecting both government and corporate debt. Hiding these numbers might be aimed at preventing panic, especially as these factors are contributing to the country's economic difficulties. Negotiations. Why did China change its stance? Initially, China declared that it would not engage in trade negotiations unless the U.S. removed all tariffs. However, by April 2025, this stance had completely changed. The reason lies in the fact that GDP grew only by 5.4% in Q1 2025, lower than expected. This weak growth shows that China's economy is facing significant difficulties. At the same time, consumer spending sharply declined, leading to major trade zones like Shenzhen turning into ghost towns, with a noticeable drop in shopping and production activity. As a result, China was forced to change its strategy and reopen negotiations with the U.S. in order to alleviate pressure both from within its economy and the negative impacts of the trade war. At this point, China had no choice but to try to reach an agreement to maintain economic stability. Avoiding tariffs via detours. Despite high tariffs, Chinese goods are still entering the U.S. through unofficial channels. Some exporters have chosen routes such as China, Malaysia, U.S., or China, Vietnam, U.S. According to Reuters, the volume of goods passing through Malaysia in 2024 increased by more than 50% compared to 2023. This situation has dragged transit countries into the vortex of trade tensions, even though they are not directly involved. Is the U.S. consumer mindset being manipulated? On one hand, it's goods. On the other, it's media. TikTok, a popular app in the U.S., is becoming an indirect tool for influencing consumer behavior. The Shopping in China campaign was heavily promoted in 2024. According to the NCRI Research Center, 70% of videos related to Chinese products are boosted by the algorithm. Videos promoting affordable housing in China, quality goods at low prices. But in reality, an apartment in Shenzhen can cost up to $460,000, while 600 million Chinese people earn less than $5 per day.
The $43 billion aircraft order could be cancelled, and the impact doesn't stop at Ryanair or Boeing. It leads to higher ticket prices, more expensive goods, and harder to get electric cars, all the burdens falling squarely on U.S. consumers. Price increases. Who's paying the price? The 25% tariffs on imports from China are creating a widespread wave of price hikes in everyday American life. A TV is now $200 more. A box of butter has gone up by $2. Clothing, shoes, electronics, and essential consumer products all are rising by 5% to 20%. Inflation in 2025 has hit 4%, pushing average monthly living costs up by $150. For high-income households, this might not seem significant, But for low-income families, that's a week's worth of groceries or half a month's travel expenses. The impact of tariffs doesn't stop at the supermarket. It's spreading across the supply chain, forcing businesses to raise prices to cover import costs. And in the end, the ones bearing the brunt are the consumers. Americans are paying more for the same lifestyle, with fewer choices available. Airline crisis. The $43 billion threat. Ryanair, Europe's largest airline, has warned it will cancel an order for 210 Boeing aircraft worth $43.2 billion if the US imposes tariffs on the aviation industry. Aircraft prices will rise, pushing operating costs higher, which will increase ticket prices by 5% to 10%. Ryanair's low-cost model is under threat. Cheap tickets will disappear, flight frequencies will decrease, and many international routes may be delayed or cut. To ease cost pressures, Ryanair is considering switching to Chinese-made aircraft, which are 20% cheaper, but they are not yet certified for operation in Europe, posing significant risks. This issue isn't limited to Ryanair alone. Xiamen Airlines from China has returned at least 3 737 MAX 8 planes due to US tariffs, causing many international flights to be delayed, making it harder for passengers to plan and increasing flight costs. Ryanair, Xiamen, and even Air India are all putting significant pressure on Boeing, and throughout this entire crisis, consumers are the first to bear the consequences. Declining sales and rising car prices. Tesla losing ground. In April 2025, Tesla's electric vehicle sales in Europe plummeted, down 60% in France and 67% in Denmark. This situation has impacted global supply, driving up car prices and limiting options. Consumers now have to accept higher prices or turn to competitors like Volkswagen, Nissan, or BYD. But these alternatives are not cheaper, and service remains inconsistent. At the same time, Tesla showrooms in Europe are facing continuous protests and vandalism. The company is being forced to scale back operations, reducing the number of models available, making it harder for consumers to find electric cars that meet their needs and budgets. Shopping woes when consumers lose their choices. Air India has temporarily suspended new orders from Boeing due to uncertainty over delivery schedules. The fleet modernization is delayed, directly affecting the plans to operate international flight routes. Passengers now face the possibility of flight delays or being forced to switch to other airlines with available fleets. In Europe, if Ryanair cancels its Boeing orders, the consequences will spread even further. Fewer airplanes mean fewer flights, and cheap tickets, one of Ryanair's hallmarks, will become scarce. Consumers will be forced to pay higher prices for tickets or wait longer to travel. Tesla losing trust. Politics hits consumers. In April 2025, Tesla saw a sharp decline in sales, down 60% in France and 67% in Denmark. Political boycotts, protests, and vandalism have caused consumers to lose trust. Tesla is no longer the top choice. Buyers are turning to brands like Volkswagen or BYD, but prices are high and supply is limited. Trust has collapsed, choices are shrinking. Consumers continue to bear the brunt. China has suspended $10 billion worth of goods, causing a 47% disruption in the flow of goods between the US and China. This not only causes car prices and iPhones to soar, but also makes shipping costs skyrocket. Can American consumers handle these changes in the global supply chain? The supply chain is facing significant shocks, with the aviation and automotive industries being hit the hardest. Boeing, a symbol of American aviation, has suspended 84 orders worth $28.4 billion. This not only causes massive financial losses, but also directly affects key international contracts, diminishing the US's competitiveness in the aviation market. But it's not just Boeing. The automotive industry is also struggling. The Ford Mustang Mach-E has raised prices by $1,200, while Stellantis has increased the cost of their plug-in hybrid cars by up to 7%. The shortage of parts and production delays are disrupting the assembly lines, and the cost of making cars is only going to increase. These changes mean consumers will have to pay more for the products they love, and many may not be able to afford them. On April 19, 2025, China suspended $10 billion of goods at the Shanghai ports, causing a 47% congestion in the flow of goods between the US and China. The impact of this disruption is spreading across the global supply chain, from the electronics industry to the automobile sector. iPhone deliveries, a popular consumer item, may be delayed by up to 2 months. Furthermore, car prices could rise by an additional $2,000 due to the shortage of parts and products. The rise in goods prices is creating a spending crisis for American consumers, with everything becoming more expensive. This shift is pushing the economy into an unstable position, with the cost of living climbing and showing no signs of slowing down. China's ports have been facing severe congestion, with 47% of the goods unable to leave the docks. This has forced producers to cancel or alter their existing contracts. This situation is causing a series of consequences, increasing shipping costs and making it difficult to determine product pricing. Shipping container costs from China to the US have surged by 250%. And this cost increase is not only hitting large businesses, but also pushing consumers into a difficult spot. Shipping companies and manufacturers are struggling to maintain stability in an environment full of risk and constantly changing prices. In light of supply chain issues and rising production costs, Tesla and Toyota have decided to shift some production to Mexico and Berlin. However, this is not an easy fix. While it may reduce dependence on Chinese ports, it comes with higher production costs and production delays. American automakers are not only facing increased costs, but also struggling to maintain production stability as the global supply chain becomes increasingly unreliable. American consumers will face continued price hikes for cars due to rising production and transportation costs. However, manufacturers can't provide stable products, leading to a shortage in the automobile market and uncertainty about prices. Major companies like Tesla and Toyota are not only shifting production to Mexico and Berlin, but also looking to expand into new markets to reduce reliance on China. But this is no easy task. Mexico and Southeast Asian countries have lower labor costs, but lack the infrastructure and production capacity of China. This will lead to higher production costs and add complexity to supply chain management. Nonetheless, this shift could create opportunities for developing countries like Mexico, Vietnam, and India to expand manufacturing and attract companies moving their supply chains. Cuba joined BRICS in January 2025, opening up opportunities for cooperation with economies that account for over 45% of global GDP. Will Cuba seize this opportunity to develop its economy and overcome US sanctions? Cuba joins BRICS, a major opportunity for Cuba. Cuba officially joined BRICS in January 2025, marking a significant opportunity after decades of isolation due to sanctions. This strategic move allows Cuba to reduce dependence on the US dollar and increase cooperation with major economies like China, Brazil, India, and Russia. With BRICS, Cuba now has access to a market representing more than 45% of global GDP, helping mitigate the impact of US sanctions. This opens up opportunities for Cuba to boost international trade, especially for goods previously restricted. However, this raises the question, can Cuba capitalize on this opportunity to grow economically? Or is this simply a part of BRICS' broader strategy to weaken US influence in the global economy, economic growth, and trade? Joining BRICS gives Cuba a major chance to transform its economy. No longer reliant on the US dollar and shielded from US sanctions, Cuba can now directly engage with major economies like China, Brazil, and India. BRICS, which accounts for over 45% of global GDP, will open new trade networks for Cuba, creating opportunities for exports and attracting investments. This helps Cuba reduce its isolation and strengthen its economic standing. Cuba can seize these opportunities to build a more sustainable economy and increase its international influence. Energy and infrastructure upgrades. Cuba is not only looking for trade opportunities, but is also preparing for a leap in energy and infrastructure. With BRICS' support, Cuba will have the chance to make substantial investments in renewable energy, particularly in clean sources like solar and wind power. This will not only reduce reliance on imported energy, but also help Cuba build a more sustainable economy. Cuba plans to invest $5 billion over the next 10 years in renewable energy development. This large investment could help the country establish a clean energy system, lower energy import costs, and create opportunities in domestic industries. By developing renewable energy sources, Cuba could become self-sufficient in energy, which would enhance the quality of life for citizens and attract investors to other sectors such as manufacturing and technology. If Cuba succeeds in achieving energy independence, it will no longer be vulnerable to oil price fluctuations or external energy supply disruptions, improving its competitiveness regionally and globally. This would not only help Cuba develop sustainably, but also open new opportunities for job creation and technological initiatives, geopolitical position, and digital transformation. In addition to energy, Cuba's strategic geographical location will be fully leveraged. The Mariel port will become a BRICS distribution hub in the Americas, enhancing Cuba's trade connectivity with other countries within the alliance. With an investment of up to $2 billion in port infrastructure, Cuba will enhance its role in the global supply chain. This not only allows Cuba to export goods more quickly, but also creates significant attraction for international partners. Alongside this, Cuba plans to upgrade its technology infrastructure and develop the IT sector, with an investment of $3 billion over the next 5 years. This will provide Cuba the opportunity to improve its startup ecosystem and foster innovation in the digital technology sectors.
Impact on the U.S. and Cuba's future in BRICS.
But what does Cuba joining BRICS mean for the U.S.? That is the big question. U.S. sanctions against Cuba are no longer as effective as before. Cuba has found new economic partners, gradually reducing its dependence on the U.S. market. More importantly, BRICS countries are increasingly moving away from using the U.S. dollar in international transactions. This could weaken the U.S.'s financial influence and have a direct impact on its economy. A notable figure is that Cuba could reduce its energy imports from the U.S. by up to 20% in the next 5 years as Cuba develops alternative energy sources and gains access to BRICS markets. 400 kilometers in just 5 minutes. Charging power up to 1,000 kilowatts. Is BYD quietly reshaping the entire EV game? Battery technology breakthrough. While many automakers are still testing solid-state batteries, BYD has unveiled the fastest charging platform available today, the Super E platform. Charging speed 1,000 kilowatts, 4 times faster than the Tesla Model Y. 5 minutes equals 400 kilometers of driving range. How is such speed even possible? Internal battery resistance has been reduced by 50%, allowing ions to move more rapidly. Silicon carbide semiconductors have been integrated to improve electrical efficiency and reduce heat. A 3-layer cooling system keeps the battery stable, even under daily ultra-fast charging. The long-standing challenges of electric vehicles, slow charging and rapid battery degradation, may finally have a solution. Strategic deployment, from premium to mainstream. BYD will first launch it on 2 premium models, the Han L sedan and the Tang L SUV. Both are established luxury vehicles in China and now serve as springboards for the Super E platform. Why start here? Because premium users are more willing to pay for new technology, exchange for early access to cutting-edge tech. BYD plans to expand this fast charging technology across all mainstream models between 2026 and 2028, as production costs drop and infrastructure matures. Infrastructure race. BYD is investing in 4,000 megawatt charging stations nationwide. Each station is designed to operate independently of the national grid thanks to built-in energy storage systems. What does that mean? No fear of grid overload. No waiting for local infrastructure upgrades. Deployment, even in remote areas. BYD's chargers aren't just faster than Tesla's superchargers. They're smarter, going global, beyond just electric vehicles. In early 2025, BYD signed a 12.5 gigawatt-hour energy storage deal with Saudi Arabia, marking the largest energy storage project in the world. They're using LFP batteries, known for their thermal stability, ideal for harsh desert climates where temperatures exceed 50 degrees Celsius. At the same time, BYD is opening factories in Europe, Southeast Asia, and Latin America, aiming to produce vehicles and deploy renewable infrastructure. Solid-state batteries. BYD began researching solid-state batteries in 2013. By 2024, they had trial-produced 20 and 60 ampere-hour cells, a major step toward commercial viability. Field tests are expected to begin in 2027, with commercialization after 2030. Once completed, solid-state batteries will offer over 70% higher energy density, meaning longer range, smaller battery packs, faster charging, greater safety, market impact. Competitors need to move faster. Immediately after the announcement, BYD's stocks surged, while rivals like Tesla, NIO, and XPeng were forced to adjust their plans. Tesla's V4 caps at 500 kilowatts, half the speed of BYD's system. Meanwhile, other Chinese brands are betting on battery swap stations. Convenient, but difficult to scale globally. User expectations are shifting fast, and automakers must adapt or risk falling behind. Setting a new standard, fast charging as default. An electric vehicle today needs more than just long range or sleek design. It must charge as fast as refueling a gas car, be compatible with modern infrastructure, operate reliably in all conditions. BYD is proving that to lead the market, it's not enough to build a powerful car. You need a smart, fully integrated ecosystem. In just 72 hours, China canceled 2.4 million tons of soybeans from the United States. That's over $1.1 billion vanished from America's trade balance. Was this just another move in the tariff war? Or is it a test run for something much bigger? A world where the US dollar might no longer be the center of gravity? In early April 2025, Bloomberg reported that China canceled all soybean orders from Cargill, ADM, and Bunge, three of the largest agricultural exporters in the US. More than 40 ships already at sea were ordered to change direction. The Chicago market reacted fast. Soybean prices dropped 8.2% in just 1 week. It brought back echoes of the 2018 trade war, when China imposed 25% tariffs on US soybeans, slashing exports by over 70%. But this time, Beijing said nothing. No press conference, no tweet, just an ominous silence. As if to say, we can change the rules whenever we want. According to the USDA, soybean stockpiles in the US jumped 13%, hitting their highest level since 2019. In farming states like Iowa and Illinois, worry spread fast. A farmer in Des Moines, quoted in the Wall Street Journal, said, "The market disappeared so fast. We didn't have time to react." The American Soybean Association warned that farm income could drop by 18% this quarter alone. That hits over 11 Midwestern states right in the budget. The USDA is reportedly considering emergency relief, while also seeking new buyers in India and Europe, markets that had stepped in during the last US-China tensions. While American farmers panicked, Brazil stepped up. From 2020 to 2024, Brazil expanded soybean farmland by 21%, backed by over $11 billion in infrastructure loans, mainly from Chinese development banks. Ports like Santos were expanded. The Ferroground Railway cut delivery times from deep inland farms to ports from weeks to days. Even Brazilian media call this the railway built by China for China. The result? China immediately replaced its 2.4 million tons of US soybeans with Brazilian crops, even paying $14 to $22 more per ton. This wasn't reaction. This was preparation. In the first quarter of 2025, US agricultural exports to China dropped 26%, a loss of over $3.2 billion, according to the Department of Commerce. At the same time, China signed long-term grain deals with Brazil, Argentina, Russia, and Pakistan, covering 70% of its import needs. Some experts are asking, is this just about soybeans? Or is it a signal that China is moving away from the US altogether, in agriculture and in global finance? Fact is, China has already cut its US Treasury holdings from over $1.1 trillion in 2017 to just around $800 billion by late 2023. No one's saying Beijing will ditch the dollar tomorrow. But the pattern is raising questions, big ones, because when one cancelled crop can shake trade, finance, and global confidence, you have to wonder, what happens when the next cancellation isn't about soybeans at all? A modest 1.7% increase in Costco's same-store sales, falling short of expectations, and almost immediately, its stock dropped nearly 6%. Is this merely an isolated incident, or is it a warning sign for the entire US economy? A retail giant shows signs of strain. Costco, long viewed as a pillar of retail stability in America, recently released its Q2 2025 earnings report, revealing figures that have unsettled investors. While total revenue increased by 4.2% year over year, same-store sales, a key indicator of retail health, grew by only 1.7%, significantly below Wall Street's anticipated 3.5%. Following this announcement, Costco's stock declined by 5.8% in after-hours trading. This development is particularly noteworthy because Costco serves as a bellwether for U.S. consumer behavior. With over 90 million members and 591 domestic locations, the company's performance offers insight into broader spending patterns. Costco's chief financial officer highlighted a significant shift. Consumers across all income levels are becoming extremely cautious. Spending power is diminishing, and these warning signs are emerging even at a retailer renowned for its value offerings, shifting consumer behavior and its implications. The earnings report also noted a 6.8% decline in electronics and high-ticket item sales, suggesting that even upper-middle-class shoppers are reducing non-essential purchases. Conversely, sales of essentials like groceries and household supplies increased by 4.3%. This trend indicates a broader defensive mindset among consumers nationwide. Surveys reveal that 58% of shoppers are buying fewer non-essential items compared to 6 months ago. Despite Costco's affordable $60 membership fee, store traffic decreased by 2.3% year over year, the first such decline in nearly 4 years. This trend has significant implications, as nearly 75% of Costco's operating profit derives from membership fees. A modest 1 to 2% drop in renewal rates could disrupt the company's financial foundation. Wider retail sector under pressure. Costco's challenges are not isolated. Bed Bath & Beyond, once operating over 1,500 stores, now has fewer than 350 and plans to close 45 more nationwide. In Chicago alone, 3 locations were recently shuttered with minimal notice. Similarly, Best Buy announced a reduction of 3,500 retail employees, while maintaining its corporate and technical staff. Interestingly, the company's stock rose by 3.2% following the announcement, reflecting investor approval of cost-cutting measures. Gap Inc. has cut 400 corporate positions, and Walgreens intends to close 1,200 stores over the next 3 years. These developments underscore a broader trend. Traditional retail infrastructures are struggling to justify their operational costs amid changing consumer behaviors, declining consumer confidence, and economic ripple effects. In April 2025, U.S. consumer confidence dropped for the 5th consecutive month, with the Conference Board's index falling 7.9 points to 86.0, the lowest since May 2020. The Expectations Index, reflecting consumer short-term outlook, decreased by 12.5 points to 54.4, signaling heightened concerns about future economic conditions. This decline in confidence is driven by persistent inflation, elevated interest rates, and job security concerns. Intel, for instance, announced plans to reduce its workforce by over 20% as part of a restructuring effort. A Morgan Stanley survey indicates that 68% of Americans plan to cut discretionary spending due to economic uncertainty, with this figure exceeding 80% among individuals aged 45 and older. These trends suggest a collective move toward financial caution, potentially leading to reduced consumer spending and broader economic implications.